Hello, I want to talk with you a little bit about how to do a journal entry. So let me go ahead and share the screen and open up a file here. And this kind of takes us back to the accounting equation, which we had looked at earlier. Now, there was a couple of things I wanted to kind of mention here real quick through this section here that I'm highlighting. And a journal entry basically is how you record transactions. Now, you're going to use the accounting equation as part of writing journal entries. It's a way like when transactions occur, kind of like what we looked at previously. Transactions would occur and they would be put to an account. That account would be increased or decreased. Well, we're basically kind of doing something similar to that, except now we're going to look at, okay, how do you analyze a transaction? Write it into a journal entry with a debit and a credit, and that's the main thing we're looking at in this chapter, in this area of the book. So let's go back to the accounting equation. Of course, it's assets equal liabilities plus equity. You remember that the things of value that a company owns, the assets, are equals the liabilities or outside debts of the company, plus the equity, which is the owner's investment in the company. And remember, equity is divided out between contributed capital and retained earnings. Contributed capital being the stock ownership in the company, retained earnings being the earnings that have been reinvested back in the business, with retained earnings being increased by revenue, decreased by expenses, and decreased by dividends. Now, remember that common stock would be the most common stock ownership in a company. Revenues, what a company earns from doing their business. Expenses, the cost of doing business, such as those paid to employees or for rent, for salaries or rent. And dividends would be whenever a company shares some of their profits with their owners. We talked a lot about this in the last section, but I want to talk about specifically about debits and credits in this one. Now, for starters, whatever you know in the past about debits and credits, you basically want to take it out of your mind because it's actually going to make it more confusing here. So whatever you know about debits and the credits, it's probably from like you made a return at Target and they credited your Visa card or they credited your account. You've heard that probably somewhere before. Well, for accounting purposes, the only definition of a debit and a credit is as you look at these accounts, and these are known as a T account. I'm highlighting it here with the assets. This is known as a T account. A debit is, as you're looking at it, the left-hand side, and a credit is the right-hand side. That's the only way you want to think about it from accounting. Debit is the left-hand side, credit is the right-hand side, as you're looking directly at a T account. Now, one thing to notice here is that for all of these accounts, notice in the T accounts, that's what it always is for the debit and the credit. Debit always on the left-hand side, credit always on the right-hand side as you're looking at it directly. Now, notice though that the increase or decrease, which a plus is for increase, the minus sign is for decrease. Notice that they are different from side to side. Now, what this means is that the increase side is the normal balance for all of these accounts. So one thing that you should notice is as you're writing journal entries is that as you're writing journal entries is that they're basically for this course going to always have their normal balance. So what that means is an asset account should always have a debit balance. A liability account should always have a credit balance. Common stock should always have a credit balance. Revenue should always have a credit balance. Expenses should always have a debit balance. Dividends should always have a debit balance. So the increase side is always the normal balance of the account. And one thing as you're doing journal entries, it's going to be kind of the same thing that we looked at in the last section, last chapter, is that the accounting equation must always be in balance, should always be in balance with these. Now, let's look at how to write some journal entries up. So, if you're given a transaction, such as a company issues stock for $100,000 to start their company, you want to ask 3 questions when writing a journal entry. One is what accounts are involved with the transaction? And so if you were looking at this transaction, you would say if a company issues stock for cash, for $100,000 cash, you'd say the accounts involved are common stock and cash. Where do these accounts fall within the accounting equation? So again, you'd go over here and cash would be an asset and common stock, of course, would fall under the common stock. So where does it fall amongst these 6 T accounts? So, and you see that there, common stock and assets. And question number 3, are these accounts being increased or decreased? So thinking about the transaction, if you're issuing stock, you're increasing the amount of stock ownership you have. And if you're receiving cash for that sale of stock, then you're increasing the amount of cash that you've got. So in this case, both of these accounts are being increased. So using the chart then, you want to decide what account you're going to debit and what account you're going to credit. So going over here, if you have an increase to common stock and an increase to an asset, what this means is that an increase to an asset would be a debit because the increase corresponds to the plus, decrease corresponds to the minus. So we would debit the asset, in this case cash, and an increase to common stock corresponds with the credit side. So that means we would credit common stock. So in this case here, we would write up a journal entry. You always want to show the account being debited first. So we show cash debited here for 100,000. Notice you've got a debit and a credit column. You go to line 2, you do a slight indentation. You always show the debit first, followed by the credit. You indent slightly and then put the credit. And then notice that is shown here. You put a short description, such as this case, issue common stock for cash. Now, another thing to note here is that debits and credits in each transaction must equal. The debits and credits in each transaction must equal. Now, let's look at it again. Let's look at a few more examples. And these are the same examples that are shown in the book. The exact same examples that are shown in the book. So, or not the exact, but very similar examples are shown in the book. Let's say that. So, we purchase equipment for $25,000. So, we would ask ourselves these questions. What accounts are involved with the transaction? And a lot of times I'd tell you the way to think about these is what are you giving up and what are you getting? In this case, they're giving up cash to get equipment. So equipment and cash would be the accounts that are involved. Second question, where do these accounts fall within the accounting equation? So we would jump back over here. And if we have an equipment and cash are both assets. So we know that both of them are assets. Many transactions you'll find are transactions where a company simply trades one asset for another. They trade cash and they get something. And so you see a lot of transactions that are like that, this being one. And then your third question, are these accounts being increased or decreased? Now, you're going to be increasing equipment because if you're buying equipment, you're increasing the amount of equipment that you have. And as far as cash, you're paying out cash to buy the equipment, so you're decreasing cash. So if we were to go back over here, an increase to an asset is going to be a debit. So that would mean we would debit equipment in this case. And a decrease to an asset is a credit. So that means we would credit cash in this case. So if you look at how the journal entry was written up, you would see a debit to cash. Remember the debit to equipment, because the debit always comes first. You would see on line 2, a slight indentation, a credit to cash since we reduced the amount of cash to buy the equipment, and just a simple description, purchased equipment. Okay, so let's look at another transaction. Let's say we purchase office supplies on account for $200. Now, we're doing something very similar to the last section that we looked at last chapter, except that we're adding in the debits and credits to it. So let's say that we purchase office supplies on account for 200. Again, we ask ourselves these questions. What accounts are involved with the transaction? So looking at this transaction, we would know that purchase office supplies on account for 2,000, office supplies, and accounts payable. But it says on account, in this case, that's accounts payable. Now, where do they belong in the accounting equation? Where do they belong in the accounting equation would be question 2. So we'd jump over here. And if we have office supplies, that is an asset. If we have accounts payable, that is a liability. And then we'd ask ourselves, are we increasing or decreasing the accounts with this transaction? In this case, we would be increasing office supplies because we're purchasing and bringing in more office supplies. We would also be increasing accounts payable because we're increasing the amount of debt that we have outstanding. So if we wanted to look at the chart then, an increase to an asset would be a debit. So that means we would debit office supplies, and an increase to a liability would be a credit. So that means we would credit accounts payable. So looking at the transaction here, we would debit office supplies. We would credit accounts payable. In our description, just purchased office supplies on account. Okay, so if we perform a service for a customer for $5,000, we would again go back and ask ourselves the first question, what accounts are involved with this transaction? So in this case, it would be service revenue and cash. Where do they belong amongst the accounting equation? Service revenue belongs under revenue. Cash is an asset. And we'd ask, are we increasing or decreasing these transactions? And in this case, if any time that you earn a revenue, you are increasing the revenue. Anytime that we bring in cash, like we are here, we're also increasing cash. So if we were going to go to the T accounts, an increase to an asset is a debit. So that would mean we would debit cash. An increase to a revenue is a credit. So that means we would credit service revenue. So if we look at this transaction here, we would debit cash, we would credit service revenue for 5,000, short description, performed a service for a customer. This is us performing a service for a customer on account. Would ask the same questions. What accounts are involved? Service revenue. This time, since it's on account, it'd be accounts receivable. Remember, accounts receivable represents a company giving basically one of their clients some additional time to pay them, one of their customers additional time to pay. We'd say, where do these belong? In the accounting equation, service revenue would be a revenue. Accounts receivable is an asset. Are we increasing or decreasing these accounts with this transaction? If we're performing a service, anytime we perform a service, we're increasing the revenue. And in this case, if we're allowing the customer additional time to pay, we're increasing the amount that that customer owes us. So we're increasing accounts receivable. So looking at the T accounts here, we would have an increase to an asset would be a debit. So we would debit accounts receivable. An increase to a credit, or excuse me, an increase to a revenue here would be a credit, which would mean a credit to service revenue. So if we looked at this one, we would debit accounts receivable, we would credit service revenue, performed a service on account. Now, if we wanted to pay some salaries, so let's say we paid salaries of $3,000. We would ask ourselves, what accounts are involved with the transaction? In this case, it would be salaries expense and cash. Where do these two belong in the accounting equation? Salaries expense would fall under expenses, and cash would fall under assets. Are we increasing or decreasing these accounts with this transaction? Both would be an Well, actually, the salaries expense would be an increase because anytime we recognize an expense, we are increasing the expense. And since we paid it in cash, that would be considered a decrease to cash. Now, looking at everything over here, a decrease to cash would be a credit. So that would mean we would be crediting cash. An increase to an expense would be a debit. Now, here's kind of a clue here. Here's something to very much help you. If you bring in cash, you're increasing cash, which means you're going to debit cash. You pay out cash, you're decreasing cash, which means you're going to credit cash. Anytime you recognize a revenue, you credit the revenue. Anytime you recognize an expense, you debit the expense. These are some things that can be helpful to you with some of these problems. And let's go ahead and do one more. And so in this case right here, if you were to pay dividends of $2,000, we'd again ask ourselves the question, what accounts are involved? And it would be dividends and cash. Remember, dividends, you're sharing some of your profits with your stockholders, which means you are going to give them cash. Where do they belong in the accounting equation? Dividends and assets. Are we increasing or decreasing these accounts? Anytime we declare dividends, we are increasing the dividends. And anytime we pay them in cash, we are decreasing cash. So if we look at the big picture, an increase to the dividend accounts is going to be a debit. A decrease to the cash account is going to be a credit, looking at the T accounts up above. Now, I will finish this with kind of another video that I will include that goes over the trial balance and also goes over basically how to post to the T accounts here. That will be in the next video.